Dan, welcome to the show today.
Hey, thanks for having me, Michael. I appreciate it. Glad to be here.
Yeah, so it's I think the first time we've had a professional snowboarder on here, and you apparently one of the most prolific medal winners in the X Games. You've medaled 4 times and received 2 golds, and I just saw a kick-ass trailer from 2018 where you're like literally snowboarding off like buildings, houses. At one point, you're jumping off the roof, and you're coming straight down the wall before actually hitting snow. Like that's sick. Like what do you miss most about that?
Yeah. What I miss most, I guess, would be the highs after landing those tricks. We call it trick high in snowboarding. It's kind of like just the most exciting moment. You're going to have this euphoric feeling that lasts for, can last for, 10 minutes to a couple days, depending on how much the trick meant to you. So that's the part I'd miss the most for sure.
Yeah, it's the highs. What about the lows?
Yeah, the lows, I don't miss the injury, the travel. Once I had this career that was this really incredible career, but I got to the point where I started having kids, and that was about 2018 exactly. And my son was born, and things changed. Just traveling and the risk to reward started to not line up. And I could see the writing on the wall. I was like, this is not going to last. And even if it could, I don't really want it to anymore. It was a childhood passion growing up. I grew up in central Minnesota, moved to Salt Lake City when I was 18. And I pushed everything. My whole life was 100% focused on this snowboarding career. And then I got maybe 6 to 8 years into my career, and things started to change slowly. And I could see I maybe had a 4 to 5 year period to wind it down. So that's when I started to really kind of look into real estate.
But you were able to make a living during this time. Is that right? Or
oh yeah. Not all pro snowboarders do. It's not quite like football, basketball, and baseball, but you can make between 500 to a couple million a year if you're one of the top guys. If you're not one of the top guys, you're probably making 100,000 or less. It's kind of like eating ramen noodles almost nowadays. But
with all the travel. But yeah, so you saw the writing on the wall as your career came to an end, and it's obviously super competitive. And what prompted you to get into real estate? I mean, obviously, very few professional athletes get into real estate. They do. They'll do everything but invest in something that actually makes sense. Now, how in the world did you get into real estate?
Yeah. Well, midway through my career, a lot of my childhood heroes became my friends. I lived in Salt Lake City, and I met all these other pro snowboarders who were much further along in their career and much bigger names than me. And as they were getting older, their careers started to wind down. And as I saw their careers winding down, it was just brutal. It was scary, losing their homes or, divorce, drug addiction. It wasn't pretty. You don't see that stuff behind the scenes. That stuff's all, he's no longer on the team. So once I started seeing that stuff, I could tell the current investments I was making with my financial advisor talking about retiring at 65. I was like, that's not going to work. I don't have till I'm 65 and my income's good now. What can I do with the money I'm making to make it work hard for me and start paying me a quarterly payment or a monthly payment and actually increase my passive income? So that was really what it was, is I was just looking for a way to maintain my freedom, having that freedom of time as a snowboarder and that passion. What the hell am I going to do without a college degree, no backup plan? Everyone was like, when I was coming up, what's your backup plan, Dan? And my backup plan answer was, there is no backup plan. This is going to work. And everyone, I think, would kind of think this guy's nuts, in which, it kind of was.
Well, you probably your friends were, you probably are. What led you to believe that you can use real estate to kind of slowly exit that? Like, who led you to believe that, or what was going on there?
I think it was a little bit of like reading Rich Dad, Poor Dad, some of those books, and understanding the difference between the E, S, B, and I quadrants. And, I never heard any of that stuff growing up. I never even knew what different quadrants there were and different kinds of income and how it was taxed differently. And I read these books, and I just there's so much here that I think is more important and better to know and more valuable than what I learned in K through 12. So that's really where it was. And just learning that you could run and operate your own businesses and control your destiny more than just giving your money to a financial advisor and just hoping and praying that at 65, they put you in the right places.
Yeah. Now, this is the problem with the Purple Book, which also ruined my life. But one of the things that doesn't, it first it messes you up, guess mentally. Because I was like, oh God, I'm such an idiot. It doesn't matter how much money I have in the bank or what my job is. Depends on how much passive income I get, right? Which I had very little, if basically none. And the only problem with the dumb book is it doesn't tell you how to get there. It mentions real estate a lot and cash flow businesses a lot. But you're like the readers, it's left to the reader's devices to figure out, okay, how do I replicate said passive income? And so I'm curious, what did you do? Like your next thing, like what was the next thing in real estate that you did? Like what was your initial path?
I started reading every book I could get my hands on regarding multifamily and passive income. And I came across Ken McElroy, which is one of Robert's kind of right-hand man guys.
ABCs of real estate investing. Yeah, great.
Yeah. And I read his book, The ABCs of Real Estate Investing. And I was like, wow, he makes it sound like it's possible. Like when you're young growing up, you're like, how the hell are you going to buy a $50 million or $30 million or $20 million building? Like you don't even know it's possible. So I started digging through books and just reading a ton of books and just doing some self-education. I started flying all over the country looking for different, forms of education. And then I finally ended up hiring kind of like more of a personal mentor, someone to help me throughout like the weekly, monthly, yearly, processes of finding deals and actually buying right.
Yeah. So did you pursue multifamily and right out of the gate? Was that your initial strategy?
Yeah. I ended up buying a 9-unit deal first, and then I bought a duplex, and then I bought a 24-unit deal all on my own. And, I could see, hey, as much as money as you're making, which again, wasn't a ton of money, but it was enough where at some point you're going to run dry. These deals take cash. So I ended up reaching out to a couple of good friends. We ended up buying a 28-unit deal together. And that gentleman, Mike, and I started Granite Towers Equity Group, which is now our investment firm where we buy multifamily value add deals and we raise capital from investors. But that was really, in the beginning, it was just looking for passive income, trying to find a way to put my money to work and learning all I could. And we, I was hiring all the management companies during my snowboarding career for those four deals or so. And I was on weekly calls with them while I was doing my snowboarding career. And it was an incredible learning experience. And luckily I was buying in 2012 where you kind of couldn't screw it up. Market was headed in the right direction. So I got lucky, really. And then I started to learn more about how lucky I actually was getting as I was buying these deals on my own, as I got more educated.
Where did you go to start getting investors when you were getting going? Did you tap in your network from before in the snowboard world, or I'm just curious about that process?
Yeah, we got a fair amount of investors from friends and family, and there were some that came from the snowboarding industry, but the majority of them came out of an investment group out of Dallas, Fort Worth. But really, a lot of it now is word of mouth and previous investors and just doing good for our investors. I think that's the best way we're really racking up more investors, is making our deals perform and giving either money back or refining and giving money back to hold long term.
Yeah, so the thing is, I think educating yourself is key early on, and it does shortcut a lot of things. In other words, you're able to bypass single family house investing, which derailed me for years, just because you're reading some books, maybe you're talking to people, and there's a lot of value in that. The problem is a lot of people get stuck in that phase, and they keep reading or listening or watching, and they never actually take action. What compelled you to actually say, okay, I'm kind of done reading these books now. Now it's time to actually make offers. What compelled you to bridge that gap?
Yeah, for me, it was kind of a positive and a negative. The part where my snowboarding career was coming to an end, regardless of what I wanted. So there was this point where I was doing well and I was like, I really should be buying multifamily. And then I started to get some feedback from some brands that some of these contracts were likely going to end, in a year or 2 years. So I could see that whether I want to buy or don't, I have to. Like, this is a point where you're kind of up against the wall. So I think that fear of my career running out and still having funds coming in to allow the freedom and have passion. And that was really it. It was just that I knew it was going to end.
Did you have financial advisors around? Like typically like athletes that I'm friends with or been friends with, they have like financial advisors that are around them or in their group of people, or I'm just curious, did you have those kind of influences around you during that time, or was it just kind of like, oh, I'm on my own?
Yeah, I had a financial advisor that I went and sought out for the call at Northwestern Mutual, like a
Yeah.
big firm, but it wasn't like a elite, like tight group of financial advisors like you're probably talking about. We talked to some athletes and they have this kind of like a higher level, more, served up platter of financial investments that's a little bit more in detail. So I didn't have that going on. There were other people in the industry that were doing, some sort of investing and stuff, but no, it wasn't really like that. It was more just kind of me on my own and realizing that I needed to do something. And I guess at the end of the day too, the kind of person I am is I want to have the control. I realized, there were so many times where I gave funds and money to people and put money in deals, or I did these sidebar investments that didn't end up doing very well. And I was really upset about those. And I'd rather me be upset at me than, saying, oh, I didn't study well enough. Here's 50K or whatever it may be. And then the 50K is gone. So I think that was part of it too, is I just want to be the one. And I believe in what we're doing. I believe in, Mike and I know how thorough we are. So why wouldn't you put your money where you know the most? And that's just kind of how it went.
Yeah, it must have been disappointing to you to not get more investors from the snowboarding world, because that was your world, right? I mean, that's what you know, and sometimes this happens, and it's you've kind of a setback, and then now you got friends and family. Were you ever concerned about taking money from friends and family? Was that kind of a weird thing?
Yeah, I always tell them if I'm close to them, this is a projection. At the end of the day, if I lose all your money and you're not comfortable with that, don't invest. And I'm pretty blunt with it. It's like you're big boy now. If you're going to come into this deal, these are our projections. My money's here. You can see how much I'm putting in. I believe in the deal enough to put my money in the deal. So if you want to take this risk together with us, let's go. But don't be calling me in 2 years if it didn't kill it, saying you hate me and you're because I'm probably going to tell you the truth. We had this call before you joined, and this is a risk. And so anyway, luckily we've never had those calls, and hopefully we don't ever. But that's how I handle friends and family that are close.
Yeah, I think there's always that bit of it's kind of a scary thing, and even now, I mean, I'm 11 years into this industry, and there's always in the back of my head, I'm like, you know what, there is a potential that something happens, and we're not going to get to the projections we thought or whatever, and then my family's involved, and so I think in general though, like at least in our industry, it's tough to really, like, you have to do a lot of things wrong to lose an investor dollar. Like, actually, they give me $100, let's say, and they give them back 50. You have to do a lot because there's so many positive things happening, and just there's so many ways to make money in the multifamily game. But the more common thing is, hey, it doesn't come out exactly as intended,
right?
Which you see. And so I'm just curious in your situation, because you started out in one place. How has your strategy evolved over time? Because you've been doing it for a decent amount of time.
Yeah.
What did that look like for you?
Yeah. And just to touch on that other piece with investors, I just one other piece that came into my mind when you were talking was, I'm almost more concerned with where the dollar ends up in 5 to 10 years versus what our investments look like. And because these investments roll with inflation, I'm more concerned for people like my parents, my brother, of them saving their dollars in the bank. And then
great point.
Saying, yeah, I feel better personally with have some cash for sure, but I feel great when I wire $100,000 into a deal or whatever I wire into a deal, $50,000 into a deal. I'm like, okay, cool. That money I don't have to necessarily worry about anymore. It's kind of in a place where it's a safe haven. So, but that's that. Getting to your next question, the strategy that it changed was, it was first buying smaller deals with my own money, recourse loan, not doing value add strategies. And now we're buying deals that are, ideally in that $15 to $40 million purchase price, somewhere between 100 to 400 units. Every time we're going to do some sort of a value add play to it, and fixing it up or changing management or whatever it may be, and then we use non-recourse debt, and just our underwriting has changed a lot, and it's become more conservative from what I was doing originally, and it's just, you don't know what you don't know.
Yeah, and that's exactly right. And things change. If you go think about when you first got started, like that first year or year and a half, think back, what was your biggest challenge at the time that you were really grappling with?
I think biggest challenge in the first year was underwriting, because I had the capital at the time. I was buying smaller deals that I could afford. But if I was going to go to bigger deals right out of the gate, which is what I should have done, I should have got training sooner. I should have got more in-depth training sooner from A to Z of multifamily.
Because if you're using your own money, right, there's no one looking over your shoulder, and you're the easiest person to lie to. It's a great deal, when you got to convince a bunch of other investors who are asking you critical questions. It's a different thing. And are you more of a numbers guy? Are you more of a relationship guy? Like, where do your strengths lie?
I would say I'm more of a team, a relationship, vision building, projections for the group. That's not to say that I'm not focused and interested in the numbers on our weekly calls, our management calls, and underwriting when we're doing our deals. But I would say Mike is probably more focused and more interested in the underwriting piece.
How do you guys split up the partnership then?
Yeah. So we own Granite Towers 50-50, but as far as when we're, in the beginning, we were both looking for deals. There wasn't much to asset manage. So we were both building out teams in our markets. We were both underwriting deals. We were both doing due diligence. We were both raising capital. And, as we're starting to get a little further along now, there's just some other strong suits that I think, he's a little more interested in better at. I'm a little more interested in better at. And now we have a podcast as well that we should probably have you on as well. And, so it's just evolving, and we're building our team out much more. Now we have a full-time accountant. We have very specific property management companies for different markets. We have our first acquisitions, an asset manager that's full-time with us. We have an underwriter that's helping us with our underwriting. So we're starting to, oversee more of a group of highly skilled, team members.
Partnerships can be tricky, especially early on. Did you struggle at all trying to figure out the partnership?
Not really, Mike. I've known Mike since I was 10 or 11 years old. We were pretty young. We were friends for a long time. And, I think our communication and our focus together has just been, knock on wood, so far, it's been just phenomenal. We've been doing this now since, full-time 2017, but we bought our first property in 2015. So, and that's not to say we haven't had some challenges. There's been some challenges for sure along the way, but, I don't know. It seems like it's just flowed pretty dang well, and we've been on a nice trajectory.
I mean, how did you, the problem is you have old friends. They know you as, the guy doing whatever you were doing when you're knuckleheads and 10 years old. It's rare that you end up in a business relationship with them. How did you guys come to the conclusion that it's a good idea for you guys to go into business? Because you went on a pretty big journey yourself. Right? You came through the snowboarding, you saw the writing at the wall, you were very motivated. And somehow Mike must have come along and kind of had a similar journey where you guys concluded that getting together was a good idea.
Yeah. I went on my snowboarding career path journey. He went through a high net worth insurance sales career, and he was buying a single family home. So his goal was to buy, I think it was 10 over the next 10 years or something. And I was buying multifamily, and he and his wife and kids came out to our place in Washington in 2015. And we were just talking. He's really good friends of mine, and our wives get along really well. And when we came out, we started chatting about what we were up to, and that kind of just came up. And I was like, man, you should forget the single family homes and let's buy one together. Let's buy a multifamily deal together. And he understood and liked it. And we have some similar values. We have a lot of similar values on money and wealth, health, so I would say the one thing to be careful for Mike and I is that we're too similar, and who do we have on our team to handle the other pieces? So that's the part where we're always, aware of.
Dan, you guys have been partners for how long?
We bought our first deal in 2015. We started Granite Towers though in 2017.
How do you guys manage the partnership? Because that's honestly, it's something that I don't think people bring out in the open enough. And it's so important. Like I had a partnership fail miserably, and it was one of the hardest experiences I went through. And I'm just curious, how do you guys manage that? And how do you guys keep it consistent and work through problems?
Yeah, gosh, I get this question a lot, and I guess I almost take it for granted in the sense that we I don't know exactly what we do, how it works. I guess communication is extremely open. We have a lot of respect for each other, I think and we always did growing up. I think that, we have a lot of similar values on money. There's not one of us who wants to spend lavishly and the other one wants to conservatively keep investing. We both are kind of that conservative invest mentality. Sure, we have times where we want to go on a trip or buy something, but we're not like overly spending. I think we just have a very clear and good communication, process is the best I can say. Unless there's something that I don't know about, it seems to me like it's just, I don't know. It just seems to have evolved.
You really did hit on some key things though. I think that the respect factor is huge. And what can happen is in any partnership, and what I saw in my previous one that didn't work out is we lost respect for each other at a certain point. We didn't believe in the same things anymore. We started to grow into separate people and with separate visions. On the company and just life in general. And once that respect was gone, it really made it hard to continue forward. And I think, people may not spend enough time on just keeping that healthy. I think it's really like a marriage.
Yeah.
I've never been married.
Yeah.
I have partners, and I hear it's very, very similar in that respect, but it's having the similar values on the money, like you mentioned, and being conservative. One person's blowing it super flashy, blowing cash over here. That affects your liquidity. Maybe that you need to go get loans. Those things, that alignment, I think is so helpful. Yeah. And so I think you're doing it naturally, which is cool, but there's still been, I think the respect over everything has helped you guys a lot.
Yeah, I would agree with you. I think the other part that's helped us a lot is we were trained very similar. When we're looking at deals and buying deals, we have, we're not trying to do a new build one week and then storage facilities the next and then multifamily the next. There's some alignment there as well.
You can have shiny object syndrome, guys, in multiple facets, right? So I think what Dan's talking about is, you could go and say, oh, self-storage is the way forward, or this, or, industrial or whatever. And I think one of the things that at least I've done personally in my career that's helped me a ton is stick with one specific niche. And it's like value add multifamily. There's been different iterations of it over time, but going deep into that has really made a big difference, and not getting the shiny object syndrome when it comes to different asset classes.
And I can't agree more. I feel like that happened to my snowboarding career too. Just that one laser focused path, become an expert at it, make sure you're the best of the best, and you're likely to find success in that avenue.
Yeah, that's really good advice. And the other thing is we learn things as we go along. You guys have been doing this for a number of years, and I'm curious, what would you do differently if now what you know now? And we look at this all the time. It's like, man, I don't really believe in mistakes per se. These are all learning opportunities, and they evolve you as a person. Clearly, you would never do your first deal again for a multitude of reasons, but it's kind of gotten you where you are today. But nevertheless, if you could sit yourself down, 5-6 years ago and have a conversation, how would you approach the business? What would you have done differently maybe?
Yeah, I would have gone and gotten deeper training from a higher level investor earlier. You think you know it, but you don't know what you don't know. And that's the part I even think about today. Okay. I'm from 2012 to 2022. I got 10 years of buying and owning and managing some multifamily to some level. Obviously the last 6 years has been completely obsessively focused on it, but still, what don't you know? You think you know it. What all of a sudden a pandemic hits. Whoa, how's this going to affect us? Right. So I think just getting training in a deeper level and understanding it at a deeper level, and then just taking massive action.
I think that's really good. I'll give you an example. My first business, I was like, well, my partner handled like the accounting, but I was kind of naive to trying to understand it as maybe as well as I should have. And even though accounting wasn't my strength and I knew it, I still I should have wanted to know it enough to be dangerous at, or just enough to understand it. Because every facet of the business, you start out with a certain skill or whatever it is. And you're like, I'm going to excel in this skill. Let's say it's finding deals or whatever it is. You go down that path, you're like, I'm really good at this. Okay, that's great. That's your stake. Okay, that's the stake that you want to basically become amazing at the steak, but then you can add the sides later to really understand the business over time. You really still want to have an idea of how the business, all the different facets of the business and how they work, so that you can speak knowledgeably about them and you understand how they all work together to be successful. And so in that instance, I actually hired a consultant that knew accounting really well in the real estate form. And I got training and I did all the books myself. And in that training, I was able to become more well-rounded as an entrepreneur and investor
Nice.
in general.
Yeah. That's great. I would agree too. When we hire our team members, we hired our accountant. He was a CBRE senior executive for 7 or 8 years, and bringing him on the team and explaining some stuff to us and helping us understand some of the things you don't fully grasp from these management reports has been super helpful. So I totally makes sense there.
And that's the other version of it. Just taking the people you can hire will teach you a ton. The HR department that we had, I built it. I didn't even know anything about HR because I never worked a job in my life that had an HR department. And so, but I had someone that knew it cold. And so I could ask this person questions all the time. And all of a sudden we had that. And so I love that you touch on that. Those surrounding yourself with those people are really important as well.
Yeah, I love that. Dan, what is your parting advice for people who are maybe where you were some number of years ago and they see the writing at the wall and they really want a solution and they feel real estate is a way to do it? What's your advice for them?
Number one is, if I can do it, anyone can do it. I feel like, there's nothing special here about it. I think getting educated and making sure it's great education. And if you're going to invest passively in deals, you can get some education too, to do some basic understanding to see if the deal sponsor that you're going to be investing with, or if you're going to be a deal sponsor, you just got to have that basic knowledge education before you even get going. So step one is just get educated and make sure it's a high level of education. And then when you start to invest, make sure you're putting your money in the deals. And if you're hesitant to put your money in the deals, you're probably not ready to be raising money.
And that is great advice, guys. One thing I looked up about Dan that's really a fun fact, that you did this thing called the gap of death. Dude, incredible. Just look at that picture when you guys get a chance. You're absolutely a legend. Thanks for coming on. A legend in snowboarding, but also creating this awesome legacy in real estate, which is so fantastic to tap into your knowledge and abilities, Dan. So thanks so much for spending time with us. How can people get a hold of you if they want to find you?
Yeah, you just hop on www.granitetowersequitygroup.com. There's a contact us form. We have a free ebook. It's again, www.granitetowersequitygroup.com, or you can send me an email, dan@granitetowersequitygroup.com.
You guys heard the man. Thanks so much.